Welcome back, everybody. The headlines lately have been absolutely insane. If you've been following the news, we're here to help you pick the signal from the noise. And one of the biggest headlines that has been going on has been that President Trump has asked the Federal Reserve to instantaneously lower the federal funds rate to 1%. So we're going to unpack that for you. One, is that even viable? Is that going to happen? If it happened, what would that mean for the economy? What would that mean for you? How does that work? Does that really mean your mortgage interest rates will be less, and how long would it take for them to be less, and how much less would they be? Spoiler alert, they won't be 1% pretty much ever, but we'll get to that. And also, at this point in the life cycle of our economy, with what's going on and what's going on in real estate right now, is interest rate the most important criteria to use for your real estate decision making? And if it isn't, what should you be using to decide whether now is the right time to buy a house or not? We're going to get into all that in this episode, so make sure you stick around till the end. I am your host, as always, Rich Curtis, and I've got with me my co-host, Dave Miller. How you doing, Dave?
I'm good, Rich. Thanks for having me.
All right, and we thank you guys for watching this episode of the Informed Home Buyer Podcast. Dave, before we get into interest rates dropping to 1%, give people just a quick primer on what's the difference between the federal funds rate and mortgage interest rates and why they don't move in lockstep with each other.
Right. Okay. So there is some minor correlation between the two, and we'll talk about the three times in recent history, that the Fed fund rate did get down to 1% and what that did to mortgage interest rates. But basically, the Fed funds rate is the rate that is set by the Federal Reserve, and it's the intraday rate that banks borrow from one another. And it's basically think of it as just lower interest rates for companies, corporations to get loans to stimulate the economy, in numerous ways, as well as go in to mention in terms of what that also does with the borrowing capability of the U.S. government and the interest rates that we pay. So
yeah. So the federal funds rate is short-term money. Your mortgage interest rates is long-term money. They are correlated, but not the same. Meaning, if the Fed dropped to 1% tomorrow, mortgage interest rates don't go to 1%. They don't even necessarily immediately go down, because it's the bond market and the 10-year T-note and the mortgage-backed securities that really drive that. So the mechanism there, if they drop to 1%, Dave, then we could say, all right, your high yield savings accounts go to crap, right? Instead of getting 4%,
yeah,
you're getting 1%. Your money market accounts go to crap, and your, not bonds, your CD, yields go
yeah,
to crap. So people have to decide with their cash reserves what to do with that money. There's a potential they move that into the bond market then, because that becomes more attractive. Even though those yields will be down, it'll still be better than that. That move into the bonds market, that is the mechanism that would trigger some reduction in mortgage interest rates, correct?
that is correct. And we've seen, really over the last, year, mortgage bonds staying in a relatively tight window that's keeping our mortgage interest rates, between 6.75 and 7.25%. We've seen a little reprieve recently, coming down in the last few weeks, and a lot of that's just basically the marketplace playing itself out and starting to see some stability with the mortgage bonds and mortgage demand, but not a significant move in rates. And if the Feds were to come and lower rates right now, where Fed fund rate sits in between a range of 4.25 and 4.5, if they do lower, it's typically done, in quarter point increments. So we're going to go to 4 to 4.25. Does that mean we're going to have a quarter point decrease in our mortgage interest rates? No. The last time, we typically, when we lower a quarter, that's already going to be baked into the mortgage interest rates, but we might see maybe a tenth better, or the cost to get that rate go down. And
Yeah.
it just takes time. It's going to take a fair amount of time to see that really play itself out. And to your point, we need to see monies flow into the bond market and see strong demand for those bonds to improve those mortgage interest rates.
Yeah. And so as of late, with the craziness that happened in the stock market, of course, Dave and I were talking offline before, the stock market is almost fully, if not fully, recovered from the Liberation Day tariff scare, where it dropped like 1,200 points. But even when it dropped those 1,200 points, what happened was people skipped right over the bond market and went to cash. And so we saw no improvement in the mortgage interest rates with all of that stock market scare, because people were so darn scared they were sticking money in coffee cans instead of putting it in the bond market.
Sure. And to your point, Rich, when the feds start lowering the Fed funds rate, the safe haven of cash and what you can get on your cash in CDs or guaranteed money, as the Fed funds rate comes down, that rate, that CD rate, that savings rate, high yield savings rate will come down accordingly. So I can see, we start seeing, one, two, three, 4 quarter point decreases. Now bonds and the return on bonds start to become more attractive than that short-term savings or CD rate. So folks and institutions will move their money back into bonds. And until that happens, and that's a process, we're not going to see an improvement in those mortgage interest rates to the level. We're still not going to see, we're not going to match whatever the Fed fund rate does. And if they go to 1, we're going to see mortgage interest rates at 1, like you already stated. But, we may see, hopefully, if they lower the Fed funds rate a couple times, we start now inching into the low 6% interest rate on a 30-year fix. That would be a good target for us.
Yeah, and I think the important point there is that the economy moves like an aircraft carrier, not like a speedboat, And
Mhm.
so it's got the turning circle of a school bus. So when it comes to something like this, Fed fund rate dropped to 1%. That benefits the banks and the governments and the billionaires instantaneously. They can borrow money that day at 1%. For us, all the normal people on Main Street looking for a better mortgage interest rate, it's going to take maybe a few months for everybody to start saying, oh, wait a second. Yeah, I had my money at 4.1% in a high yield savings account. Now it's down to like 1 or 2%. That doesn't make sense. I got to now do some research, figure out do I want to put that money in bonds? Do I want to, maybe I'm going to invest some of it in the stock market now to get my 7 to 10%, S&P 500 returns on that money, and not have some of it in a safe haven because I just can't stomach getting no returns. Maybe I'm going to put it in bonds. There's a whole decision tree that happens there, both at the institutional level, which happens quicker, and at the human level for us, which happens slower. And all of that has to happen, and enough money has to move into the bond market for us to see those mortgage interest rates move, which leads us into, if it doesn't benefit us instantly, why is Trump calling for a reduction in interest rates? And anytime we try to ascribe reasons to someone else's decisions, there's always risk there. We're not inside the man's head, nor do I ever want to spend a day in that head. But what I think is happening here is, and this is economics, not politics, a big, beautiful bill will add trillions in debt to the U.S. Government's debt. Currently, that debt is at the federal funds rate for, any of the debt that is provided by American institutions, 4.75%, 4.5%, whatever that is. He needs to borrow a whole bunch of money in addition to slashing programs in order to fund that bill. And he wants to borrow that money at 1%, not 4.75%. So if he could get Jerome Powell, that's the federal funds chairman, to drop the interest rate to 1%, instantly he can start borrowing money to fund that bill at 1%. That's what he wants. That doesn't necessarily benefit us, both from the perspective of having a lot more debt that our grandchildren will have to pay for down the road, but also it's not going to benefit us in terms of mortgage interest rates. So when you see the news come out and say federal funds rate down to 1%, don't start doing jumping jacks and getting excited that you're about to get a home loan at 1% and that Washington cares about your home loan. That's not what's going on here at all. It could have a tangential benefit in months to come. But also, Dave, do you think they're going to do it?
Well, they're not going to lower it to 1%. I can tell you that. We're going to see quarter point decreases. And I think we will see 1 to 3 decreases before the end of the year.
Yeah.
And again, the Federal Reserve has a dual mandate. They're managing inflation and they're managing unemployment. So they want to stimulate employment and they want to keep inflation in check of their inflationary target of 2%. So that is their mandate. And I think Powell came out and said yesterday that,
Yeah.
had the tariffs not been put in place, we probably would have already seen the Federal Reserve lower interest rates.
Yeah.
And, how many times, once, twice, how much, didn't specify, but, there was a wait and see, and they're letting the data determine what they're going to do. And it's trailing data. So, the last thing the Federal Reserve wants to do is overreact and lower something and cause inflationary numbers unnecessarily. And it,
And
yeah,
and that's a good segue into the historical perspective of when we put interest rates at 1%. So Powell has said we would have already reduced had the tariffs not happened. So the tariffs created a financial crisis, an artificial one, right? So
Yep.
in the dot-com bubble, that was a real financial crisis that was happening. There was no one person in charge of that. There was no one lever to pull to stop it. Versus with the tariffs, all Trump had to do is stop talking about tariffs and stop putting on tariffs, and this wouldn't have happened. So he's manufactured a financial crisis. Now, when the defecation really hits the oscillation in the economy, those are the only times that we have ever put the federal funds rate to 1%. So those have been, for people old enough to remember this, the dot bomb, the .com explosion, where all of that stock market value evaporated in a very short period of time. So 2003, 2004, right after that, to try to get the economy going again, because it had such a big effect, that recession, they dropped it to 1%. The other time, Dave, was a big moment in our careers. What was that one the next time?
Yeah, that was the Great Recession, which we saw those numbers late 2008, early 2009. And, we saw those, Fed fund rate. And then what they did at that point in time, again, was what they called quantitative easing, which was a bond buying program from the federal government, was buying those mortgage backed securities, which artificially lowered the mortgage interest rates.
Yes, which there is some leaks out of Washington to say that the Trump administration is talking about trying to force that to, if they can't force the Fed to drop it instantly to 1%, they're going to try to start a T-note buying program there or mortgage-backed securities buying program to try to do it that way. Hopefully they don't do that. And the third time, of course, was COVID that we all experienced, right? And when we got those of us who got these great, 3.5, percent interest rates, some even in the high twos, that's the other time they dropped the federal fund rate to 1%. So it is in times of extreme financial crisis that they do this. It is to try to help us, but it is not without its downside. The inflation that we're experiencing now is directly in response to all the money the Trump administration printed during COVID, all of the interest rate stimulation they did during COVID. So particularly in the case that this is a manufactured financial crisis due to the tariffs, so you create a problem, and now you say, I want the funds rate down to 1% to solve the problem because you actually want to borrow money at this amount. That is kicking the can down the road and causing this problem to exacerbate. The inflation will get worse, the economy will get worse, and we're going to be stuck in this cycle. We essentially, from the Great Recession all the way through the end of COVID, never really stopped printing off money, never really stopped artificially manipulating interest rates. And this inflation that we went through, that Trump will blame on Biden and Biden will blame on Trump and everybody will blame on COVID. This has really been since the 2005, 2006, the real beginnings of the Great Recession. From then till now, we as a country have made choices to do this and to print money and to artificially manipulate interest rates. And finally, the economy couldn't take it anymore, and we started to pay the piper with this inflation situation. So if the Fed was to do this again, and especially doing it just artificially on a whim because Trump wants us to, this would cause much, much bigger problems. So it's a case of sort of be careful what you wish for.
Yes, 100%. That's the point I was just going to make. And so, I think we've come to a point in the last, I would say, 6 months to a year where folks that we're talking to have kind of accepted the rate environment that we're in, and fewer people are holding out hope that rates are going to be in the 4 or 5% range and anytime soon. So when you hear the news, you hear the Federal Reserve or the pressure to lower the Fed funds rate, we're not going to see, like you said, Rich, unless something, be careful what you wish for, major happens, we're not going to see any major decreases in interest rates. So incremental decreases, but that shouldn't be the determining factor of whether you're going to buy a home or not.
Yeah, and I was not in the business in 2003, 2004, the first time this happened. I got in the business in January of 2005. So I experienced the Great Recession and the COVID one. Dave, you might have been. Were you were early in the business? 03,
Yeah,
04?
I was early in the business, but even then, when the Fed funds rate was lower, we did not see the mortgage interest rate. There wasn't the same bond buying program then because housing wasn't the major issue.
Yeah, right. It was a stock market problem that
It was
time.
the stock market, and so interest rates in the early 2000s, still when we were in the 5 and 6% range.
Well, even in the Great Recession, when they instituted the bond buying program,
Yep.
I think for one brief blip, it actually dropped to like 3.9 for like a second.
Yeah,
But
yeah.
most of the time, we were 4 to 4.5 all
Yeah,
the way through the Great Recession.
that is correct.
Even
We had that
even with the
HARP
federal funds
program.
rate at 1% and the bond buying program, right?
That is correct. And
Yeah.
so, with the exceptions of, and so again, there's never just an exact direct correlation. But that did artificially bring our rates down at the time. We were the mid to high sixes, and that brought us, like you said, down to the low 4 percentile, and for a blip, high threes. But that was huge reprieve for those folks that were able to refinance, and people that were able to refinance without, based on the government program of not having to have the equity to refinance at that particular point in time. So if your house value dropped by 30% and you had a Fannie Mae or a Freddie Mac mortgage, you were still able to take advantage of lower interest rates regardless of your equity.
Yes, yeah. That was the big deal. And what dropped them even lower, how we got into threes and twos in COVID was we were we were just printing out money ridiculously and pushing those rates down ridiculously because people weren't able to work and all this stuff, all of the stimulus and everything else that got that rate environment down to sort of a once in a lifetime blip. But even then, it's important to say it never went to 1%. It can't go to one. You can't
No,
make money. You couldn't really make money at the 2.5 to 3.5 mortgage.
right.
They were barely making money at that point. So this isn't the kind of thing where you're going to see a mortgage interest rate hit 1%. So if you saw the news and you thought, oh man, I'm going to wait because Trump's going to get this guy, he's going to fire him and put in a patsy and get him to 1%, or he's going to force this guy to get to 1%, and then I'm going to get a mortgage at 1%. I'm going to not buy a house until I see that 1%. That's essentially never going to happen. So that shouldn't be your decision-making criteria for when or if you buy a house this year or next year or at any point. And I think that's a good segue, Dave, into is interest rate the best metric right now for deciding whether or not to buy a house? And if it isn't, what is? And I think interest rate has been the primary metric for people's decision making from July of 2022, when the interest rate essentially doubled or started there to double, up until Liberation Day, basically when the tariff insanity
Yeah.
started.
Well, and there was a
Uh,
few things going on too at that point in time, Rich, where those rates stayed arbitrarily low for a fair amount of time. And then what
yeah,
had happened is they didn't gradually go up, right? When
yeah,
inflation really kicked in,
yeah. They
rates shot up very quickly. So like we always talk about on this podcast is, if you maintain the five fundamentals, and, you have good job security, money for down payment, you are willing to be, where you want to live for a minimum of 5 years, your credit scores in, decent shape, and you have a reserve account. Like, those are the folks that still, I think, if you check those boxes, um, and you're in a position where you're thinking timing might be right to buy a home, there's some benefit now in terms of watching inventory increase and home values come down.
yeah,
I've been doing this a long time. I bought and sold a lot of houses, and one of the things that I know in terms of at least the values of homes is you're never going to time it perfectly. If you're a
yeah,
seller, you didn't time the top perfectly. You didn't lose money because you didn't sell it 6 months ago. You didn't lose $50,000 because you went, your value of your home doubled and you didn't time it perfectly. Um,
yeah.
you, you know,
100%.
and same thing for a buyer is you can buy that home and the value may drop below what you purchase it for in the short term. Typically, you look at historically, we're going to see that come back long term. And that's why you and I encourage, if you're in a position to buy a home, take advantage of the home benefits of home ownership. But if you don't have to get out of Dodge in the next foreseeable future, then it really doesn't matter what the value of your home, as you always say, and we talk about, only matters the day you buy and the day you sell.
Yeah, exactly. And that's why I think interest rate at this point is what it is. What we think, Powell did just say yesterday or the day before, first time he's actually sort of committed to this, saying, I think we will see a reduction by the end of the year. But what we know is that's likely to be a measured, and conservative reduction. So a quarter point is what they usually do. So what we're anticipating, Dave, I think is, between 1 and 3 quarter point reductions by the end of the year,
Yeah.
potentially.
Yeah. That seems to be the consensus. I've heard some pundits say that unless things change drastically, we might not see a decrease. But right from, Jerome Powell's mouth yesterday, I would highly expect that we're going to see something. And maybe, they meet again here in a couple weeks. We might see a July decrease. We may not. But I would definitely anticipate 1 to 3 before the remainder of the year.
And so best case, let's paint the best case scenario: 0.75 basis points by the end of the year, so 3/4 of a point um, uh, in federal funds rate reduction. What might we get out of that in interest rate
If we
reduction?
saw a 3/4 point Fed funds rate reduction, I would hope to see a 1/4 point in interest rates.
And so today we're on, 6.8 or so.
Roughly 6 8 range. Yeah. So let's just say if they were to lower, 3/4, we might get to the 6.5 range. Um,
Yeah.
you
So
know,
that's
for
go ahead.
yeah, we kind of use a $500,000 purchase price. For someone that's got somewhere between a 400 and a $450,000 mortgage, maybe you put 10% down. You're probably looking at probably $40 per eighth in interest rate, $40 to $60 every eighth in interest rate. Um,
Yeah.
Not going to
So
be, yeah.
yeah, not going to be a primary. If that amount of money is the go or no go point for your house purchase, you should not be buying a house. Your finances are too tight. It's not a good idea. So that's the case for interest rate at this point not being the primary decision making point in your house purchase. So what do we think it should be? Should you be going right out and rushing out to buy a house? Well, prices are coming down. Inventories are up. Inventories are up 40 to 70% across the state of California. So we're seeing much higher inventory. We're looking at right about nationally 2009 levels of inventory, which is notable. It's a different mechanism. We're not going to see the 40 to 50% price reductions that we saw in the Great Recession, but it is notable that those 2009 inventory levels were right before prices really started to slide off in terms of the Great Recession. And so we are at increased inventory levels. I believe truly in my heart we are going to see price reductions over the course of this year. What are those going to be? Is it going to be 1%, like Zillow and Redfin says? It's just a BS placeholder number. It allows them to say prices are going to come down without sticking their neck out. I believe we're going to see much more than that, especially in California in our markets. I would be willing to say I'm guessing at least 2 to 3% by the end of the year, and possibly more. It just depends on what happens. But so price wise, if you're on that ragged edge, right now, waiting and watching might be a reasonable thing to do. So, what's the decision-making point for you to get into the market? I think what Dave alluded to is the best thing. Well, one, your have tos. So, if you have death, divorce, job loss, job change, any of that kind of stuff, and you have to do something, okay, it's not actually a bad time to do it. Don't be scared by what you're seeing in the news. If you have a have to transaction, get it done. If you don't have a have to transaction, then work on those 5 fundamentals. Work on your credit. Get in touch with a lender. If you're in our market, call Dave. That's for Dave. That's all of California, all of Nevada. You can also call a realtor and kind of get started on that process if you have a house to sell. So if you're in the 5 counties, Sacramento, El Dorado, Amador, and Nevada counties and Placer counties here, you can call me. If not, we can connect you with someone in your market. But get on the phone with your realtor, get on the phone with the lender, work those 5 fundamentals: credit. Do you have stable employment? For me, that would be the biggest one. If I'm feeling like I'm going to lose my job, I'm probably not going to buy a house. So stable employment. Do you have an emergency fund? Do you have your down payment saved up? Work through those 5 fundamentals with the lender. Get in a position where when things get to where you want them to be, when the prices drop a little bit, when you're feeling good about it, then you can pounce. You're totally prepared when the opportunities come, because this market is going to present opportunities for some of you, and I want you to be prepared. I was not prepared in the Great Recession to really take advantage of those opportunities at that point in my life. I wish I had been, and I want you guys to be prepared this time. So no one's saying go out and buy a house today. What we are saying is go out and make sure you're ready and watch for those opportunities, and don't be waiting for a 1, 2, 3, even 4% interest rate. That's not coming this year or next year, most likely.
Right. And to your point, Rich, when we're talking about home values coming down and, prediction of the remainder of the year, 2%, 3%, that's only relative to fair market price for a house. I mean, we've seen this, we just saw it happen recently with some joint clients where if the house isn't priced right, we saw $100,000 price reduction on a home, or nearly
Yeah.
$100,000 price reduction. I mean, so that was a 15% price reduction. So if someone overprices their house by 50,000 and they need to lower it by 10,000, they did not take they didn't technically lower the house $60,000. I mean, they came off the listing price, but they lowered it maybe 10 or 15% just to get to where the real value is today. So, and we continue to see a lot of that. Someone, listens to a listing agent and says you can get this much for a house because it's much harder to increase the value of your house when you go to sell it than it is to lower the value of the house when you go to sell it. So
100%. And in this kind of market, as it's shifting under our feet, some people just won't let go of that pandemic era mindset of I can just put it up for whatever price and 15 people will come pay me whatever I want, right? There was a moment in time when that was true. That moment isn't now, and there's an educational piece for people in our industry to help sellers come around to that. Some realtors have the guts to say it to people at the kitchen table and tell them what their house is really worth, and some don't. And so that's why working with a trusted professional who could tell you, yeah, that house is wildly overpriced, is a huge benefit to you. So make sure to choose wisely when you choose your representatives, wherever you guys are watching from or coming from. So I think that's a good place to wrap it today. Oh, Dave, do you have another point you were going to
nope,
make?
that was it. I was agreeing with you. I think we covered it.
I think that's a good place to wrap it. The upshot here is uh, Jerome Powell has said he's not going to reduce the Fed fund rate to 1%. Could they fire him? Maybe, but I don't see that really happening. There'd be some big backlash for that. So I don't see the federal funds rate going to 1% unless the deflation hits the oscillation in the economy such that it makes sense to do so. And even if it did, you're not getting a 1% interest rate. So this is all a bunch of political noise and not valid decision-making criteria for real human beings in terms of whether to buy a house or not. That's what we wanted to bring to you today. We want to help you make the highest quality real estate decisions you can from the comfort of your house. We want to help you kind of pick out the signal from the noise because the news is real noisy at the moment. I hope you found some value in this. If you're still here, you spent 27 minutes listening to us prattle on about interest rates, and we deeply appreciate your commitment to your financial education. We will see you guys on the next one. I'm Rich Curtis.
And I'm Dave Miller. Thanks, Rich.
All right. Have a great day, everyone.